Hello, everybody, and welcome to the 2021 Economic Update. My name is Joe DeQuino, Chair for 2022 for SRC-YPN, and it is our pleasure to have Jordan Levine here to give this economic update. Jordan Levine is the Vice President and Chief Economist at the California Association of Realtors, a statewide trade organization of real estate professionals with more than 200,000 members. Jordan is responsible for C.A.R.'s housing market and economic research, as well as the policy analysis for C.A.R.'s legislative and governmental affairs efforts. He has a passion for homeownership, is actively involved in the company's diversity, equity, and inclusion initiatives, and regularly represents C.A.R. to its members, the real estate industry, policymakers, and in the local and national media. Jordan has a bachelor's degree in economics from the University of California, Santa Barbara, and a master's degree with merit in international economics from the University of Sussex. Prior to joining C.A.R., Jordan worked in consulting as an economist and director of economic research, where he oversaw all research and economic analysis on California's economy and housing market. Regularly spoke to trade groups, public officials, businesses, and the media. Ladies and gentlemen, I'm proud to present Jordan Levine.
Thank you so much, Joe, for that introduction. I appreciate it, although I need to make sure I go back and pare down that bio. It's a little bit too lengthy, but I certainly appreciate the hospitality and the opportunity to be here. This is kind of my old stomping grounds in a way. I'm from San Diego County originally, all of my family now in kind of Southwest Riverside County. So it's an area that's near and dear to my heart. I'm a little bit under the weather, so please bear with me as I go through this analysis. But oh my goodness, this took on a life of its own. But where I wanted to start was where my old boss and mentor Leslie Appleton Young always started, and that was with what she called a cadence of accountability, basically telling you how we did on last year's forecast so that you know kind of how much stock to put into everything else I'm about to tell you today. And if you look at where we were at this time last year, basically end of September, beginning of October, when I issued that 2021 forecast, at that time, we had expected that this year things would continue to improve after a significant hit in 2020. We had sales going up a little bit, 3.3%. We also had prices going up a little bit as well, 1.3% to about 650,000. Unfortunately, almost immediately after issuing this forecast, it was pretty much dead on arrival, right? Because we had a significant surge in the public health crisis, right? The pandemic numbers went through the roof almost immediately after I issued that forecast. And we had numbers in November, December, and January that rose to unprecedented levels that we hadn't seen thus far in the crisis. And so what ended up happening was actually that 2020 ended up being incredibly strong relative to our initial projection, right? Instead of having home sales that went down, we actually ended the year at almost 412,000 home sales, right? We had prices that actually went up by 11% last year, again, largely because of such a tremendous surge during the fourth quarter where, there was this kind of renewed passion for home ownership that we've seen fairly consistently each time the public health numbers deteriorate. It actually makes housing stronger. And that's been something that has been, again, pretty consistent. So we were already coming into 2021 on a much stronger tailwind than I had originally projected. And that's why if you look at where our projection is for where we're going to end up this year, right, we actually have a little bit more than twice as much growth in transactions as what we originally forecast. We think that sales are going to be up 7% almost, and they're going to be up from a higher initial starting point of 412,000 units last year, bringing us to almost 440,000 home sales. We also have a lot more price growth, and I think that's where we really missed the mark, right, is that the prices came in at almost 800,000 this year, which is going to result in about a 20% increase. And so, that was something that Again, as we kind of saw the coronavirus numbers go up, the demand for housing also went up, and that was met directly with a lack of supply and also low mortgage interest rates that really drove prices through the roof. And so prices were, sales were a little bit higher than what we originally projected. Prices were a lot higher than what we originally projected. And so, when the dust settles, I'd probably give myself about a C- on last year's forecast, right? We had the direction correct. We had sales going up. We had prices going up. But the big thing that we missed was the huge increase in prices as a result of all of that excess demand and those extremely low rates, right? So we kind of had our story a little bit off kilter because of that resurgence in the coronavirus case. When we look forward to what that means for 2022 and beyond, and you ask me about the forecast, I think you're really asking me a couple different questions, right? You're asking me first and foremost about the kind of macro economy, right? Is that kind of broader economic tide going to be rising? And although we do see that we're entering a period of increased uncertainty, not just because we're entering the winter months and COVID remains a kind of wild card, even though we have a lot of folks who've gotten their shots, et cetera, but there's also kind of rising global economic uncertainty, whether it's Evergrande in China, the kind of global energy costs, inflation, what have you. There is a period of kind of rising uncertainty, but barring any unforeseen shocks to the economy, we're pretty optimistic about that kind of, that macroeconomic tide. We see more jobs being restored. We see incomes finally starting to rise, and that actually leading to more spending, but also more importantly, from a real estate standpoint, more of those kind of life events that really spur changes in people's housing situation, right? You get married, you get divorced, you have babies, your mom kicks you out of the basement, what have you. We think all of that stuff will start to rebound as the economy normalizes. And currently, we're at a point in time where that public health side of things is improving, right? But you're not just asking me about the kind of rising tide, right? You're also asking me how housing specifically is going to do. And we know that housing has been the kind of bright spot in the broader economic landscape. Will that continue? Will we continue to punch above our weight? And I think that, that is something that we really have to look at through the lens of, how much of this shock driven kind of demand is going to be more transitory in nature, right? Are we already starting to see signs of things go back to normal? And also kind of what changes are going to be a little bit more persistent, right? And I do think that there's new challenges that we're going to face as a result of this crisis. And I also think that what it's going to do is make it more incumbent on us than ever before to get serious about our kind of broader structural challenges, our pre-existing conditions, if you will, the headwinds to the housing market that we had in place even before COVID-19 broke out. And of course, finally, what does it all mean for us as individual real estate practitioners, right? How do we interpret these numbers, especially ones that seem pretty optimistic? And I think that it's still very much a kind of nose to the grindstone environment, right? It's still very much a market share game, because even as we have the kind of broader tide rising and the housing market continuing to do well relative to other sectors of the economy, it's still a very tight game at the individual practitioner level, because we still have, not enough transactions to go around, frankly, relative to the size of the member base. And so in some ways, the kind of the message is to keep your foot on the accelerator and don't get misled by these kind of positive economic trends, because you really are the master of your own destiny. And that's one of the things I love working for the realtors for anyway, right? And so bottom line is that, yes, those cyclical issues are fading, but you don't want to kind of go into autopilot mode, because we have longstanding structural issues that are kind of reemerging, and those are being compounded by new structural challenges associated with the kind of future, the new normal, the normal 2.0, if you will. But let's talk about that rising tide, because that's kind of, a critical prerequisite for what happens in the housing market, right? That when people are working, when they're making more money, when their incomes are rising, et cetera, that is generally a good thing for housing. And there, the news is relatively upbeat after a pretty significant surge in cases during July and August. The public health crisis is starting to get a lid on itself, and you can see that we've been trending downward pretty consistently for the last 4 to 6 weeks, and actually those numbers are pretty encouraging. Although I will note that this is the area that we completely missed the boat on last year. In fact, we're basically right in that same time frame that we were at when I made my projection for 2021, right, where we were coming down off a significant increase in COVID cases last summer, and things were looking on the up and up. We had an economy that we were expecting to continue to normalize. And again, lo and behold, we had this surge, this unprecedented increase in the number of cases and the number of deaths, hospitalizations, what have you. And that, again, reinvigorated the demand for housing. And we had just a phenomenal fourth quarter that actually drove those prices so much higher than what that original projection is. Of course, we're in a much different environment today than we were back in October, of last year. But I would be lying to you if I said that this wasn't an ongoing wild card. We don't expect the kind of resurgence that we saw last November, but it's very possible that we will see these numbers go back up again before it's all said and done. And that does have an impact on kind of broader economic conditions. The good news is that, outside of that one spike in COVID that we had back in November, the kind of broader economy has largely been on an uptrend, right? That if you go back to the onset of this crisis, yes, it was the deepest and most significant decline over the quickest amount of time in recorded history for California. We lost between February and April of 2020. We lost about 2.7 million jobs, which, in statistical terms is basically overnight. But you can see here that these blue bars, once we started to get our arms wrapped around social distancing, I mean, we weren't opening up the economy by any stretch, but we did start to, understand masking, get our kind of arms wrapped around what it meant to live in a kind of pandemic environment. And outside of that November to January timeframe, we've generally been adding jobs back at a steady clip. In fact, through September, and we just got new data a few days ago, we had already added back about 1.7, a little bit more than 1.7 million of those 2.7 million jobs that we lost last year, right? So we still probably have about 1 million jobs to go to get back to where we were pre-crisis. And we probably still need another 500,000 or so on top of that to not just get back to where we were, but put us back to those long-run trend lines that we should have been on, but for the effects of this crisis. But all in all, what this means is that we're about 60% of the way towards full recovery and moving in that right direction fairly consistently. That is good from the standpoint of incomes, and just that kind of broader macroeconomic tide, right? When you, look at those 2.7 million jobs that we lost last year, and you look at how those were divided out across industries in California, this is what the kind of econ nerds like me call the K-shaped nature of the recovery, where folks at the bottom end of the income spectrum, and here I'm showing you the 4 lowest paying industries in California in red. The 4 highest paying sectors in California are green, and you can see that the job losses disproportionately fell on those kind of lower wage, face-to-face, non-remotable jobs, leisure and hospitality. That's our bars, our restaurants, our hotels, what have you, retail trade, which is fairly self-explanatory. Other services is where all of our kind of personal services are, our dry cleaners, our nail salons, our barbers, et cetera, and administrative support, which are those kind of entry-level jobs that we use across every industry. Those sectors disproportionately bore the brunt of the COVID lockdown, right? And if you look at these green sectors, these high wage sectors, they were much less impacted. These were folks that were relatively insulated from the crisis. And again, from that standpoint, the strength of that housing market really starts to make a lot of sense, because if you think about what industries were sourcing all of California's home buyers pre-crisis, affordability, housing supply, et cetera, being what it was, you really had to be in one of these high income earning categories in the first place to be able to achieve home ownership. And these were the exact folks that were, again, relatively unaffected by the crisis. In some cases, they were doing even better than ever financially. They're companies that make these kind of tech products that let folks do things remotely, right? That are able to avoid having to commute to the office or pay for parking, et cetera. These are also the same folks who potentially own property already or own stock portfolios, both of which recovered much quicker than that broader economy. And so when you kind of put that all together with the fact that the nature of this crisis made our homes more important to us than ever before. Our CEO, Joel Singer, said that this crisis has really increased what he called the value of home, right? And there is this kind of renewed passion for home ownership, because our house isn't just the place you go back to at night, grab a bite to eat, lay your head on the pillow before you head off to work the next day. It's where you live. It's where you work. It's where you do your kids' schooling. It's your gym. It's your bar, et cetera, et cetera. We needed these homes to do more for us than ever before. And so you kind of had this increase in flexibility with this renewed passion for home ownership, intersecting with this kind of relative economic advantage of high income earners and the ability for those folks to work remotely. And you really had kind of a perfect storm for housing demand, particularly when you kind of throw it all in the pot and you mix it around with 2.66% mortgage interest rates. And that really creates this kind of incredible tailwind for housing demand. And of course, we saw this show up in the housing market during 2020, and that has continued on to this day. You'll note here on the right-hand side that we have seen interest rates go up a little bit, and we've been above 3% now for the last 2 weeks in a row, according to that Freddie Mac survey of 30-year fixed rate mortgages. But I'd be remiss if I didn't remind you that I'm the son of a guy who, in the early 1980s used to drag me around all of his dinner parties, bragging to his buddies about his 12.5% mortgage interest rate, right? When you take a kind of very zoomed out perspective on where interest rates are, where they've been historically and where they still are now, I think that, rates are still going to be a tailwind for the housing market moving forward. In fact, I think second best probably to rates that are at all-time low levels in terms of at least creating a sense of urgency for buyers is concern that rates in the future will be even higher, right? And I think that will continue to motivate buyers to try and take advantage while the getting was good, as it were, right? And of course, we did see this play itself out in the housing market. In fact, we came into 2021 at a 15-year high for closed transactions. We ended last year with almost 510,000 home sales on an annualized basis. That was up almost 30% from where we were in December of 2019, when there was no pandemic and we were at all-time low levels for unemployment in the state. In fact, what's really incredible is that on a year-to-date basis, California ended last year up 3.5% from where it was in 2019 as a whole, right? And if you stop and think about it, it's really incredible, because it means that even with all those lost sales during March, April, and May of 2020, we more than made up for that lost ground during the second half of the year, clawing a huge chunk of that back just in the final quarter of the year to again end with even more home sales than we had when there wasn't a pandemic, when we didn't lose 3 months of the prime home buying season. And that's why, even in the dead of winter, we were setting what was at that time all-time high prices of almost $720,000 as inventory dropped to an all-time low level of 1.3 months, right? So we did see this kind of perfect storm for housing demand, the economic insulation, the low rates, the renewed passion for home ownership, and the remote work really kind of conflate to create this 15-year high for the market coming into 2021. But what's interesting is that if you look at the shape of demand last year, and I'm trying to set a kind of a contextualization of last year so that we can use that as a lens to look at the more recent numbers. But if you just look at last year's stuff, right, that I mentioned, California as a whole ended 2020 up 3.5% from the previous year. But there was actually 20 cities last year that grew by at least 40%, right? That clawed more than all that lost ground back to end up not just by double digits, but by 40% or more. And if you go through and actually, try and understand the common bond between these really top performing cities, they generally fall into one of two categories, right? You either have your kind of very high end, affluent, high cost markets like your Malibus, your Montecitos, your Rancho Santa Fe's down in San Diego County, Tiburons up in the Bay Area, or you kind of have a mishmash of cities, but the common bond that they all share is that they don't necessarily host big employment centers and they're high quality of life kind of recreation resort type markets. Your Big Bears, your Lake Arrowheads, right? Your Lake Tahoes, your Truckees, your Indian Wells and the kind of Palm Springs area, or the Sierra Nevada foothills. And so what we saw was that we had this perfect storm for housing demand that kind of created what I would call this opportunistic outmigration that really characterized the 2020 market, with these being the markets that absolutely performed best last year in terms of new home sales or existing home sales, right? You can see that same kind of trend play itself out if you look at it by size of home instead of by geography, right? After being incredibly tight around about 1,740 square feet, it stayed pretty much plus or minus 2% of 1,740 square feet. That was the median size of a home that was transacting in California, plus minus 2% for the better part of the last 3 years in a row. But you can see that almost overnight, with the onset of the crisis, the size of the home that people were buying, and this is on median, right? So we're getting rid of all the outliers and stuff, but that jumped up by about 90 square feet, right? Which to my mind equates to about the size of a home office, right? And so it wasn't just where they were buying, but it was also what they were buying. That again, our homes are more important to us than ever before because we needed to be able to do all of this stuff, have Zoom meetings, right? Do schooling and stuff. And you saw that kind of materialize in terms of the product that people were buying out there last year, right? If you look at it in terms of the product type instead of the size of the product, right? You can see a similar story. And this is just showing you data last year at the onset of the crisis. But if you look at single family versus condo last year, right, when the single family market was falling by 30 and 40% in April and May, the condo market was falling by 40 and 60%, right? So you see this kind of similar effect, whether you look at it by size, by geography, by product type, that there was this kind of surge in demand outside of the core, not in the big cities, not in the dense condo type products, and that really did kind of, characterize the shape of demand last year, right? And what we saw was that was a lot of these kind of long-term renters who did have that perfect storm for housing demand and finally did want to take that plunge and get their foot on the property ladder. And that continued through this year as well. In fact, even as the number came down a little bit in our 2021 annual housing market survey, you can see that the last 2 years have been basically decade high levels for the share of the market that was from first-time home buyers, right? So there was this kind of increase in the value of home that, for whatever reason, whether it was the flexibility, the low rates, the opportunity to move to one of these, resort type markets and work remotely or what have you, you saw these long-term renters finally be motivated to take that jump into home ownership. If you look at who these folks were from a kind of financial standpoint, again, it really makes sense through the lens of that economic data that we talked about earlier, where the relatively affluent long-term renters were the ones making this jump into home ownership. If you look at the percentage of those first-time buyers that I just showed you that put at least 20% down, that's been about a third of the market for the last 2 years in a row, right? So these were, again, those high income renters with lots of savings and these kind of remotable high income jobs. It wasn't your kind of $50,000 a year scrap your way into the housing market type of buyer, which is kind of depressing from a home ownership standpoint. But I think it does still underscore this kind of renewed passion for getting your foot on the property ladder. When you think about it from the standpoint of systemic risk, again, the percentage of folks going into the market with nothing down, the percentage of the market that was going in with a kind of exotic 5/1 option arm type mortgage product were negligible, portions of the overall market in absolute terms, and especially in comparison to where we were back in 2005, 6, 7 timeframe. So, again, lots of passion for home ownership, but only those kind of high income earners and relatively affluent renters were in a position to be able to take advantage of those low rates. And you see the same kind of story if you look at it not by down payment, but instead by income. And you can see now that the first time buyer median income, which means that that's the midpoint of income, right? 50% of first time buyers made even more than that number, but you can see that they're already earning well in excess of $100,000 a year, which again makes sense through the lens of economic data, where those top end of the income spectrum are doing better than ever. The property values, the stock market has all grown much more quickly than the Main Street economy. And so you get a lot of demand from those relatively affluent first-time buyers. You also have a lot of demand continuing in that kind of vacation and second home market. And I think that will continue to be kind of music to the ears of the folks in this room, right? Because that kind of plays to the sweet spot of the local market, being a high quality of life area, lots of wineries and what have you. I wish I was down there myself instead of doing this remotely, because it's such a nice place to be. But that continues to also characterize housing demand in 2021, and we had again a decade high essentially of kind of vacation and second home market demand. You see the same kind of thing if you look at it by price segment. I'm sorry I keep wiping my nose, but I'm just a little bit under the weather here. But if you look at it by price segment, you can see that this blue line, 2 million and up, has been, head and shoulders ahead of the rest of the pack for the entirety of the recovery period. So you had, a lot of relatively affluent renters buying their first home. You had a lot of, affluent folks who already own homes buying second homes, vacation homes, and overall just a lot of high-priced home sales. Excuse me. In fact, actually, for the last 5 months in a row, which is kind of a scary thought, that we now sell more homes at or above $1 million than we sell homes at 500,000 or below. And it wasn't that long ago when 500,000 and below was pretty much the entirety of California's housing market. And so you can see just how much that kind of overperformance on the economic side has really dominated the shape of housing demand up to this point in the recovery. Of course, I kind of already alluded to this, but all of those trends should hopefully be music to the ears of, the Inland Valley, the Southwest Riverside area, because you really do see that we're kind of embodying a lot of these same trends. And I kind of tried to organize these from north to south on this table, but you can see that, we're still talking about double-digit sales growth in, pretty much across the whole region, right? Where sales are up by at least 10% or more for the most part across the region, and the market is still incredibly competitive, right? We're talking about single-digit median time on market with the majority of homes. In fact, in many cases, we're talking about 3 out of 4 homes actually closing above list price, right? What's interesting about the local market compared to the rest of the state is that, and this is those same markets I just showed you, but sorted by price, with the lowest price markets on the left, highest price markets on the right. In the rest of the state, we're seeing a kind of an overperformance at the top end of the market, right? Like when I made this chart, I was expecting to see Temecula, Norco, and Eastvale growing the fastest and Moreno Valley growing the slowest. But what you see is that, for the most part, most of Region 14 is still just growing by double digits in terms of closed transactions. And so, one of the things I think that we can look forward to is that after some of that kind of opportunistic out migration to some of those really outlying areas, further even into the valley or through the pass and Palm Springs or up in Big Bear and Lake Arrowhead and things like that, is that, we're starting to see some normalization back to these kind of, what I would call employment center adjacent regions. One thing I think that we can expect to continue to stick around, though, is that those high income earners will continue to punch above their weight. And I already showed you the 2020 numbers, but here's where we are through the first 9 months of 2021 with growth in transactions going across the bottom, the median price of each market going up the y-axis here, and each one of these dots is a city in California. And this is kind of that trend that I was talking about, which we don't really see in the local market, where the top end is just kind of head and shoulders above everywhere else. But for the most part in California, the kind of higher cost areas are the ones that are doing most of the growing right now. In fact, if you just look at the top 100 fastest growing of these dots on the left-hand side, and just ask how many of those are markets with at least $1 million median prices, you're talking about, 3 out of 5 of those markets have at least $1 million median prices. About 1 out of 5 has a median price in excess of $2 million. And so again, putting that kind of nerdy economic hat back on, I think these numbers make sense. And we expect that the top end of the market will probably continue to overperform because the top end of the economy is expected to continue to overperform. And in some cases, whether it's tech, whether it's stock valuations or what have you, those numbers are at all-time high levels, even as other parts of the economy like hotels and retail are still struggling to recover. I know nobody cares about Northern California, but I did want to just show you this geographic distribution of transactions here. And this is growth in transactions, because I do think that it signals somewhat of a normalization that should actually be encouraging to the folks on this call, right? Because this is growth in home sales through the first 9 months of the year compared to the first 9 months of 2020. And if you look at where all the green is, even in Northern California, it's not kind of out in your Sacramentos or in the Sierra Nevada foothills or anything like that. It's mostly concentrated where the bulk of the jobs in Northern California are also located, right? So we saw that, yes, we're still selling a lot of homes in those high cost markets, but we're seeing a lot of that demand in the high cost markets of the kind of core employment centers of the state. You see the same thing kind of playing itself out in Southern California as well. That yes, you still see a lot of growth out on the right-hand side in your kind of Palm Springs area, right? And you see some growth up in the kind of Big Bear, Lake Arrowhead part, but you're also seeing just a ton of growth happening, all along the 10, 60, 91 corridor, including into Southwest Riverside, right? And so again, even as we kind of had that opportunistic out migration of folks who were able to work remotely and take advantage of the kind of low rates and all of that stuff, go out and buy homes in Big Bear last year, what you see is that demand is starting to migrate back, at least geographically, to where the kind of bulk of demand has always been. And I think that's going to, continue to make, especially as some folks go back to the office, like kind of play to the strengths of the Inland Valley and Southwest Riverside, where you kind of have that balance between size of home, access to employment centers, affordability and what have you, compared to what you find along the coast. And that will probably lead to a resurgence as we move forward. When you just think about the housing market from like a 30,000 foot perspective, I mentioned that through the first 9 months of the year, California as a whole is up about 20%, give or take. It's only doing that well because the coastal economies are growing so much in terms of transactions, right? The Bay Area, Central Coast, and Southern California, which does include the Inland Empire in our calculations, are again punching above their weight. So yes, you had some folks go out to Lake Shasta, to Big Bear, et cetera, but you also have real, honest to goodness growth in California California's core. And again, when you look at it in terms of time on market, right, that is what I'm showing you on the map on the left-hand side here. The deeper red, the quicker the median time on market. And you can again see that where the market is most ferocious and this is just Riverside County data, which is at 15.5% for the year to date in terms of closed transactions. But the markets with the most red, with the lowest time on market, we're pretty much zoomed right in on our home base there. And so again, that is in the context of a market that's growing in sales and prices. And so we see a lot of those kind of broader themes that I was developing at the state level starting to play themselves out here in the local economy as well. Now, I should point out that, there is no going back to normal completely, right? We're just normal-er than we were last year, right? We're starting to look a little bit more like we did before the crisis than we did during the peak of the crisis when more folks were doing that kind of opportunistic out migration. One of the things that comes with the normalization is that you have buyers who, after being so bullish on housing last year, and you can see in our housing sentiment survey of consumers, we actually had an increase last year in the percentage of folks who thought it was a good time to buy a home. That passion for home ownership was there. Unfortunately, as we kind of progressed through such an inventory constrained environment for such a long period of time, buyer fatigue started to set in, right? That we started to see people get burned out on housing. They were putting in offers, they were getting outbid. You had other buyers who were willing to put down more money, pay all cash, waive all contingencies, what have you. And that took its toll on home buyers. The number that said it was a good time to buy a home was cut in half. Luckily, that has started to come back a little bit in the recent months. Buyers aren't particularly bullish on housing, but I think that as we start to see more inventory, there will be opportunities there. But we do have to acknowledge that there is some buyer fatigue out there because supply has been constrained for such a long time. That's why sellers, by the way, on the right-hand side, you can see are still fairly optimistic, even if they're not at all-time high levels of optimism like they were a few months ago. And unfortunately, this is something that will have an impact. If you look at the number of mortgage applications, you can see that for the last 22, 23 weeks in a row, and these are just purchase applications, so I've already gotten rid of all the refis, right? But if you just look at purchase applications, we're 23 weeks in a row, give or take, where we've had fewer home buyers filling out a mortgage application than we had at the same week of last year. And what's worse is that shifted out by about a 6-week time horizon, does a pretty good job of predicting where closed sales in California are going. I will note that we're not falling as much as the broader mortgage application number. So California is still outperforming the rest of the United States in terms of its housing market, but it's true that we've got some work to do on the buyer demand side, especially while rates are still, at levels that my dad would have killed for, right? And because we know that isn't just showing up in the number of stuff that's closing on a weekly basis. We also see that in the pending sales numbers, right? That there's fewer homes entering escrow for the 4th month in a row in September, right? And so part of a normalizing market is that we're not able to hang on to those 15-year highs for home sales that we started 2021 on. And so even as we're still roughly 5 to 7% above pre-crisis levels, you do see that we've been pretty consistently sliding from that 15-year high that we started the year with. We don't think it's going to fall much further. We think it's going to remain pretty stable because, again, this is a supply issue, not a demand issue. You still have lots of people who want to get into housing, but we just don't have the supply, and that's pumped up prices, eroded affordability, et cetera, that prevents us from staying at those kind of high levels. It's not just sales, though, that are reverting back to normal. You can see here that we've had a modest uptrend in active listings. We're still incredibly depressed, even by the standards of 2018 and 19, which weren't particularly good years for housing supply. But the September number didn't decline the way that it normally does with the kind of seasonal slowdown in active listings. And that is something I think we can look forward to as the market continues to normalize, that hopefully these will continue to move in the right direction. We still got long run issues on that front, but a few extra listings, in such a constrained environment makes a big difference. And actually, you can see what impact that's having, both in terms of the kind of slightly reduced demand, but also a little bit more supply in terms of market competition, right? And we're not a cooling market. Don't let anybody tell you that we've cooled, but we are seeing that just quote unquote 62% of transactions last month closed over list price, not the kind of 3 out of 4 transactions that it was at about 6 months ago. And you see the same thing in terms of days on market, right? That homes are still going pending in less than 2 weeks. They're just no longer going pending in less than 1 week, right? Which is a little bit of a window of opportunity for us to, I think, start talking buyers back into the market again after having gotten pretty beaten up over the course of the last year or so. And you see that little bit of increase in inventory, that little bit of reduced competition shows up in prices as well. Yes, we're still at about $810,000 in terms of a median home price, but we're talking about growth that's only 13.5%. I guess I should have put the air quotes on that still, not the kind of 35% growth that we were at a few months ago. So to my mind, this means that, supply and demand still works. It's that, which is kind of reassuring. I wasn't paying all those student loans for the last 20 years for nothing. That when you have an inventory constrained market that persists for such a long time, that what it does is it, reduces demand a little bit. Some folks get priced out of the market, get fed up, what have you, take a step back. You also have some sellers who look around and go, oh my gosh, it's a good time to put my home on the market. And both of those things kind of are what you're seeing play out, that indeed the markets still work. And so even as we kind of see things starting to go not back to normal and not new normal, because that's so cliche, but maybe normal 2.0, right? That there are some signs that things are a little bit transitory. We saw that both in terms of the size of the home finally starting to come back, the geographic migration back to where demand had always been growing. But I would be lying to you as well if I didn't point out that I think that some of our structural challenges that we had coming into this crisis, our pre-existing conditions, have been exacerbated now due to the nature of this crisis. And what you can see here is our annual housing market survey, where we ask realtors, where did your seller go, right? And what you can see here is that this, the percentage of sellers who sold their home and then moved out of California completely, that number's been going up for a while, right? This is a kind of long-standing trend that we've known about for quite some time. But if you look at the right-hand side of this chart, what you see is that that gap between 2020 and 2021 got bigger, right? This was an acceleration in that long-standing trend that has been in place for a long time. And we know that folks want home ownership. It's still, synonymous with the American dream. A lot of passion, probably more passion for home ownership than ever before. But now folks have more flexibility. They don't have a gun to their head forcing them into the employment centers in California in order to keep that high wage job. And indeed, you saw more folks actually leave last year. Similarly, that remote work effect, I think, is going to be more persistent. You saw the percentage of sellers who sold a home and then bought another home in their exact same county also declined by a faster pace. We saw that out migration to another part of California accelerate last year. And so I do think that these are going to be kind of structural challenges that are only going to be more urgent moving forward. And we can see that even though we don't have 2021 demographic data for California, that the Department of Finance backs up what the realtors told us in our annual housing market survey, right? Because just last year alone, we had an acceleration of over 260,000 Californians leave the state. We had, for the first time in recorded history, a decline in California's population. And again, I think that this kind of underscores how our supply challenges are more urgent now than ever before, precisely because people have flexibility, because they really want home ownership, that when they have the flexibility to get it, we better get serious about being able to deliver on that American dream, or they're going to go elsewhere. And not to get too preachy, but this is a function of supply, right? That we don't build enough. In fact, even with a projected 20% increase in new building permits this year, we're still going to fall 60,000 units short of where the state says we need to be just to be able to tread water on housing affordability, right? I think 180,000 units a year is conservative, but that's what the state estimates. But you can see that even again with a double-digit increase, we're still falling about 60,000 units shy. And that's just, the 180,000, to my mind, that's like the number we need to make just to be able to kind of like make that interest payment on our credit card, right? Forget about bringing down the credit card balance that's been built up by the fact that we've only ever hit 180,000 units 5 times in the last 35 or so years. But even just to make the interest payment, we're still falling 60,000 short of that number. And again, I think that lies at the heart of all of our woes, because not only do we just not have enough homes out there, full stop, the homes that we do have don't end up going on to the MLS. And we see in our annual housing market survey as well that people are living in their homes about twice as long as they used to. We got rid of the kind of negative incentive on the property tax side with Prop 19, but you still have capital gains to grapple with. And the bigger piece is where you're going to move to, right? You could sell high, but then you got to turn around and buy even higher. And it's kind of the 1-2 punch when it comes to housing supply, that not only do we not build enough homes, but then the homes that we do have don't change hands. And that's why even in a kind of rate environment that my dad would have killed for 40 years ago, and this is our second quarter number, but even with the lowest rates in recorded history, we still had an erosion in housing affordability, that the increase in prices more than canceled out the benefits of lower rates. And now we're entering a period where rates will probably start to rise. And so again, that will be the kind of double whammy when it comes to housing affordability for folks that need to take out a mortgage. That's why, we already had a 10 percentage point gap with the rest of the United States when it comes to home ownership. It's particularly egregious in the segments of the population that are probably going to form the bulk of housing demand moving forward, right? And so we've got to get serious on that. And you really can't draw a straight line from kind of that lack of new construction to all of these kind of crazy records in terms of our housing outcomes: low vacancy rates, low housing inventory, record high home prices, record numbers of people living rent burden. That means they're spending too much of their income on rent. The second worst state in the nation for overcrowding, and why we're dead last when it comes to poor people, right? That once you account for the cost of living, which they don't do in the regular poverty estimates. That's why they put out a supplemental poverty estimate where they look at how much cost of living is in each state, so that we're not comparing, using the same poverty cutoff for Toledo, Ohio, as we're using for, Eastvale with an $800,000 median price. Once you do that calculation, California, again, is dead last in terms of poverty. And again, you don't have to be a fancy mathematician to understand the roots of this crisis. If you go back to the mid-1980s, we were about a 25 million person state. Now we're a state of almost 40 million people, right? If you go back to the mid-1980s, we had about 110,000 realtors. Now we've got about 210,000 realtors, right? We have twice as many realtors as we had back then. And yet we build about a third as much as what we used to build back in the mid 1980s. And again, that's why even with more people, more realtors, we still, even in a year of 15-year highs for closed transactions, we sold about the same amount of homes that we did 30, 40 years ago, right? And so again, I'd be doing you a disservice if I didn't point that out, because it's going to impact our clients, right? And I talked about how it leads to the erosion of housing affordability, to the double-digit increases in prices that we've seen, but it also impacts us as real estate professionals, right? Because I showed you how that plays out in terms of number of deals relative to the number of real estate professionals, which means that it also impacts the kind of our slice of the pie, as it were, right? And so even as we're kind of optimistic about the broader economy, that sales are going to hold up well, that jobs are going to continue to come back, that we'll see unemployment continue to improve and prices continue to rise, you still have to have a very much a kind of foot on the accelerator type of approach to your business. Because what we've seen over the course of the last couple of years is that the rising tide has really only lifted some boats when it comes to the individual personal economy of an individual realtor, right? You can see that over the course of the last couple of years, the kind of market share of the top 20% of agents actually went up, right? Some agents that were the top producers before are doing even better than ever now, right? And actually, you see that in the aggregate income statistics. In fact, if you look at mean income, the average income of a realtor in 2020, add up all the commissions divided by the number of realtors out there, that number was up by 16+% last year, right? That incomes went from 155,000 on average to 180,000 on average. And really what that's showing us is that the amount of commissions went up a lot more than the number of realtors, but it doesn't really say much about your own individual experience of being a realtor. And there, if we look at the median income, right, the income that's in the middle, you start at the top producing realtor and the bottom producing, you work your way into that very middle typical member, and their incomes went down by almost 17%, excuse me. So even in the midst of a market with all-time high prices, a 15-year high for closed transactions, the typical member didn't necessarily get their own slice of the pie. And that's why, when you look at our forecast, yes, we have that macroeconomic tide rising, right? We have GDP continuing to grow by about 4%. We have jobs coming back by another 3% next year, and we even have inflation starting to normalize away from the kind of elevated levels we were at. In fact, we even have California doing better than that. We have an almost 5% expansion in our non-farm payrolls and a bigger improvement in overall unemployment. We also think that we'll reverse course on the decline in population that we had in 2020. We won't see a big increase, but we'll at least get right back to square one. And yet, when you look at the how that plays itself out across the housing market, that yes, we think that sales are going to stay at a relatively robust level, especially by pre-crisis standards. We have sales of almost 420,000 next year, but that will be down about 5% from where we expect things to end up this year. And so even as we're kind of optimistic that sales will remain relatively healthy and excuse me, that prices will also continue to go up, we aren't predicting a kind of cruise control type of environment for transactions when you can just kick back and kind of ride the wave, right? So to summarize, I think the good news is that broader economic tide is rising. Jobs, incomes, all of that stuff should be moving in the right direction, including the COVID numbers, which continue to improve. And we have, still a lot of buyer demand out there. That kind of renewed passion for home ownership is alive and well, maybe stronger than ever, even as it's still a pretty good time for sellers out there. So rates are going to probably go up, but they'll still be relatively affordable by historical standards. Sales will come down a little bit, but they're going to remain pretty solid, and prices will continue to go up. The bad news is that we're up against it now in terms of addressing our structural challenges. They were there before the crisis, and now they're even worse. And that's going to have impacts on our clients, first-time buyers, in terms of affordability and down payments. Even though my dad would have killed for 3% mortgage interest rates 40 years ago, the thing my dad didn't have was $830,000 median home prices. And so even small changes in rates have big impacts, all of which kind of adds up to ongoing headwinds for home ownership. And that's before we even talk about the rest of the environmental stuff, what's going to happen with the portals, with the Department of Justice and NAR and iBuying and all these other things. And for me, I think that's why, it's key to keep in mind that even as we're kind of optimistic about the broader economy, you got to keep it real that rising tide is only lifting some boats. And so this is really what I was trying to do. That is me. And hopefully that's you. And I think that, we do have that broader tide rising. And if you keep to your nose to the grindstone, then 2022 can be your best year ever, but it's still just very much a market share game. So I'll leave it there. I thank Daniel so much for the opportunity to be here speaking with you. If I haven't beat you into submission, I'm happy to consider any questions that might be out there. And thank you all so much for your time.
Awesome. Thank you so much, Jordan. That was an excellent presentation. I do have a question about labor out there. So as we're seeing, if you go around the businesses, there's a lot of hiring signs out there. Where'd all the workers go?
So there's a skills mismatch out there, right? That the companies that are growing, you know, and the workers that lost their jobs, if you think about the Venn diagram, there's not a lot of overlap there, right? Because you've got, you know, places like your Zooms, your Facebooks, your video game companies, all punching above their weight, leading the charge, sometimes have stock prices that are 30% higher now than they were, you know, before the crisis. But if you're an unemployed, you know, hotel worker, right? If you're a cleaner at a hotel, or if you work at a retail establishment or a restaurant that's no longer in business or what have you, you're not necessarily in a position to take advantage of those jobs. And so there's kind of that aspect of it. I also think that we'll start to see some workers, even at the bottom end of the spectrum, start to come back into the labor pool, right? That, you know, there's a lot of challenges with things like schools and daycares and stuff that prevent some workers, even though their company might be hiring back the job again, that precludes them from kind of jumping back into the market. And I think we're still kind of in a pandemic environment, and I think that's still affecting people's behaviors. But pandemic unemployment insurance just ran out. The extra amount that you got on top of your regular unemployment has run out. And the thing that we've seen too is that, you know, for the most part, people do want to get back to work, but they're just trying to find that balance. And I think that this is another area where it might take some time, but supply and demand will work, right? Because you're already seeing that with this kind of constrained labor force, businesses are starting to step up and you know, bump up wages, be more competitive with benefit packages. And so it's kind of the same thing that we see in the housing market, right? That after being so inventory constrained, then you have 7, you know, out of 10 homes selling above asking price. You get a couple sellers who decide to throw their home up onto the market again. And I think that will happen, but it's just a process that takes, you know, months to play itself out, especially because we have all these kind of government distortions, I think, that are kind of playing themselves out and kind of winding their way out of the system, if you will.
I was muted, sorry. Thank you for that. That was a good explanation. Okay, and I don't see any other questions, so I'm going to hand it over to Joe.
Thank you, Jordan. On behalf of SRC, YPN, and everybody attending, we'd like to thank you for taking the time out of your day to give us this update. The information is absolutely priceless, and I hope everybody enjoyed the time here this afternoon for this economic update. And I'd also like to take this opportunity to thank our annual sponsors, Old Republic Home Protection, My NHD, and United One Realty. So thank you, everybody, for attending. And yeah, we'll see you again next year.
Thank you all. See you on the next one.
Bye.